Hi, and welcome to another presentation from your business tutor, learning your way, anytime, anywhere. One of the major fears that puts people off starting a business is that if they were to fail, they would be left with huge debts to pay off. So with that in mind, let's turn to today's presentation on private limited companies, which may solve this issue. Okay, so what are we going to learn in this presentation? Well, first of all, we're going to find out what a private limited company is, and then we're going on to investigate the advantages and disadvantages of being a private limited company. Okay, let's get started by asking, what is a private limited company? A private limited company is an organisation that is in the private sector and always contains the abbreviation LTD at the end of their name to signify that they have limited liability. For example, Walker's Shortbread Limited and Baxter's Food Group Limited. Such organisations are owned by individuals called shareholders who provide the initial equity or money required to start the business. However, although shareholders own the organisation, they are not responsible for managing it. Instead, they appoint directors who are senior managers to run it for them. This is quite an interesting point, as it shows that the ownership and management roles have been split, which is completely different to a sole trader or partnership, where both roles are held by the owners. Now, before moving on, it is worth noting that although the roles have been split, that in many private limited companies, the shareholders and directors can be the same people, especially when a company is first formed. This is because the shareholders who start the business often appoint themselves to run the company as well. However, over time this may change, as new directors may need to be appointed if the business grows in size, the original directors retire, or there is a change in ownership. Okay, let's now turn to look at the advantages of being a private limited company. The biggest advantage of being a private limited company is that such organisations have limited liability. This is really important, as it significantly reduces the risk that shareholders face when they invest in a company. This is because should a company fail and fall into bankruptcy, the most the shareholders can lose is what they invested. In other words, if a shareholder only invested £100 in buying shares, this would be the most they could lose, even if the debts of the business were greater than this amount. Now, although this benefit is significant, it becomes even more so when compared to sole traders and partners who are personally liable for all the debts their businesses incur, because they have unlimited liability. A second advantage of being a private limited company is that as the shares cannot be publicly traded on a stock exchange, it is fairly straightforward for the shareholders to maintain ownership of the organisation. This is especially the case as often the original shareholders will put restrictions on the sale of shares when the company is formed. For example, it may be the case that if a shareholder wants to sell their holding, that they may have to offer their shares to existing shareholders before they can sell them to anybody else, meaning the likelihood of a hostile takeover by another business is very low. And finally, it is possible for a private limited company to raise finance by issuing shares to a range of investors. However, as most private limited companies are set up by only a small number of shareholders, this advantage rarely occurs. Okay, let's now turn to look at the disadvantages of private limited companies. One of the main disadvantages is that there are significant legal requirements as outlined in the Companies Act that must be adhered to when forming a private limited company. For example, the company must be registered at Companies House and have a certificate of incorporation issued before it can start trading. Further still, and at the same time, a company must produce a Memorandum of Association and Articles of Association which outline what the organisation has been formed to do and the rules and regulations under which it will operate. More than this, however, Private limited companies also have ongoing legal obligations, such as having to produce and publish financial statements that detail how much profit they have made and how much their organisation is worth. This can be an issue because it means that anybody can see how the business is performing, especially competitors. And finally, as most private limited companies only issue a few shares to a small number of investors in order to control ownership, it means that raising finance in this way is very much limited. Okay, so what did we learn in this presentation? Well, first of all, we found out what a private limited company is, and then we went on to investigate the advantages and disadvantages of being a private limited company. There is no doubt that private limited companies address the concerns that many people have when starting a business. In fact, the concept of limited liability is why many entrepreneurs set up a private limited company rather than forming a sole trader or partnership business.